Since his first day on campus, I guess.
Marcelo was my RF back in stage row. So thanks for coming, lots of people. I'm glad my friends came because this is more oriented toward lay people than toward econ people, and I was worried I'd end up in this very disappointed room of econ knowledgeable people wondering about my methodology and stuff. So, yeah, we're talking today about reverse mortgages, bequest, and budgetary decision making in retirement. So let's start here. This is a graph of median net worth across various age groups, right? So, here's the red thing. The blue line is with home equity included as an aspect of net worth, and the red line is without it. The bottom line here is that most people's wealth, especially as they get older, is in their house, right? Non-controversial point. Here's another point. We're in a retirement savings crisis. Most people don't have pensions anymore. Very few people, or a disproportionately small number of people, have access to defined contribution plans. Interest rates are really low, etc. So the result is that, as these people pointed out, this is just, you can find any number of areas of research about this. 66% of households, in their estimation, are not ready for retirement. 40 million working age households have no retirement assets, and the median account balance for those 62 people about to retire at the median is $14,500. That is not enough to retire. It's probably only going to get worse. For example, the Social Security Administration has reported that Social Security income is more than half of the income of 51% of married couples in retirement, and is more than half the income of 74% of singles. And they're probably not going to have that income for much longer. The Social Security Administration estimates that we are going to pay down the entire Social Security Trust Fund by 2034, and at that point they will only be able to guarantee 79% of promised benefits. They would pay directly out of payroll taxes every year. We are currently, since 2010, outflows of Social Security have exceeded inflows, so we are currently depleting the trust fund. So what's a reverse mortgage? Say you're one such senior, right? You've entered retirement, you've paid off your mortgage, you have all this wealth in your house, but you suddenly have no cash. So you go to a bank, and I'm paraphrasing a lot here, but the bottom line is that it's an agreement with a bank where you get to stay in your house and you get money. You get like some proportion of the house's value in cash. But when you die, the bank gets your house. It's a trade-off. You get to relax your liquidity constraint, but you have to lower your budget constraint because you're getting only a proportion of the value of your house, and you can't bequest the house when you die. So what's a reverse mortgage? Right. But it's also a policy issue. Reverse mortgages have existed since the 60s as an idea, but they were really at the fringes of consumer finance until the 80s. To make a long story short, the idea is that if you're a reverse mortgage originator, you face two areas of risk, right? You face actuarial risk, which is the risk that the senior lives too long and you keep having to pay them money and you end up having to pay them more than you thought. But you also face appreciation risk, which is the idea that you could expect the home to be worth $2,000 when the senior dies, but then it ends up being worth very little, just with normal fluctuations in the housing market. So what the government did in the 80s is that they stepped in and they created a thing called a home equity conversion mortgage. This is just the specific kind of reverse mortgage that's insured by the government. Basically, if your home reaches certain standards, it can qualify as eligible for a home equity conversion mortgage. You pay into an insurance pool when you get the mortgage, and then it is a reverse mortgage. You get money, and then at the end of the day when you die, if the home has lost value, the bank is covered by a payout from the insurance pool. So their only area of risk, now that the government created this product, is actuarial risk, right, that you live too long. So if I lost you, the bottom line is that the government made this kind of thing, which makes reverse mortgages viable as a way to deal with the fact that most people have no money in retirement but have all this wealth pent up in their house. Cool. Consequently, since now that you have like all of these chains fitting together, you have most people having their wealth in their home, they don't have enough retirement money, and now with home equity conversion mortgages, it's viable that they could tap the equity to generate liquidity. They're growing a lot, right? This is region to region. In 2016, the Rocky Mountain region, they grew origination grew almost 55%. Various failing news sources have pointed out that people are recommending them. And now a lot of long-term care facilities, because basically nobody has long-term care insurance, which is just insurance that, like, if you're old, you end up needing care for a long time. It would pay for it. A lot of long-term care facilities are now saying, if you get a reverse mortgage, you could pay for long-term care. So this is looking at the quantitative side. Origination tracks the value of homes because the value of the reverse mortgage depends on how much you get paid out. So you can see origination rising as houses became more valuable before the recession. Then the housing bubble popped, but now they're rising back up. And this isn't actually like visually very encouraging, but I assure you, if you read the report that this is from, this is an annual report from HUD. Their whole point was that origination is returning as home values return to their previous levels. Here's why we're here, and I'm about 5 minutes in, so I need to get to this. With your reverse mortgage, your home goes to the bank, right, when you die. But traditionally, the biggest thing you give to your kids is your house when you die. So there's a mismatch here. And bequests are macroeconomically important. There was a debate in the 80s between these guys, Kaufman, Summers, and Modigliani, basically saying, okay, how much wealth in life cycle models of wealth generation is attributable to bequest? Because even a small to moderate bequest early on in life, or even midway through life in your 30s, if your parents die, then can have big effects throughout the entire life cycle. So these guys basically looked at all the literature and said, okay, generally bequest is attributable in most models to 15 to 31% of life cycle wealth generation. That's a lot. The bottom line is that we can see this kind of sequence and say, and raise questions. We could say reverse mortgages are growing, they require that houses not be bequested, but bequest is macroeconomically important. This is a guy named John Ogilvy at the Consumer Financial Protection Bureau, where I worked this summer. He was talking to me one day, and he raised this exact point. He saw reverse mortgage origination rising, and he said, oh my God, what's going to happen? This is Martin Schneider, who's my thesis advisor. I brought him this idea in the fall, and he said, whoa, 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 whoa. We don't actually know that all the wealth is going to the bank. It might be that people are getting all this liquidity through reverse mortgages, but then, you know, increasing consumption somewhat, some amount, but not entirely. And maybe they do reallocate some of the liquidity that they get through the reverse mortgage back into their estate, right? So they mitigate the loss to state. So that's the question. Does seniors' decision to turn home equity into liquidity through a reverse mortgage change their consumption and saving behaviors, and by extension, does it reduce their bequest? Specifically, yeah. Do they consume a little bit more and mitigate the losses, or do they consume a lot more and really liquidate their estate? And then, because this is a policy issue, how does this influence what we think about this idea of a home equity conversion mortgage? So the method, there's really not a lot of literature about these. They were a fringe product for a very long time. These two recently wrote a paper that's probably going to be very foundational in the field. They were looking at how exogenous life factors would affect, just more broadly, decision-making in retirement, including reverse mortgages. They were looking at quantifying how different life factors would influence whether you would get one, and trying to show like welfare changes. My goal here is to take their model and use it for a different thing, which is to focus solely on consumption and saving allocation, and then by extension on bequest. And the novel application requires certain assumptions, certain small changes. For them, time is continuous. For me, it exists in two phases. You are a retiree, where you decide to consume, and then you die and you bequest, right? And you make some allocation decisions in retirement. You can enter only in my model as a homeowner with substantial equity. You need substantial equity to qualify for a government reverse mortgage. Nakajima and Talyakova had renters. I don't model renters here. With the assumption being that if you were to sell your house, and we're going to talk a lot about selling your house instead, you would end up with some cash equivalent. Because, and this is an important point, traditionally, if you were an old person who didn't have any cash, you would just sell your house and downsize. The whole point is that with a reverse mortgage, you can relax your liquidity constraint without having to move. And just as a methodological note, this is for the econ people, saving is anything in the estate. So if you don't get a reverse mortgage and you bequest your house, that is counted as saving. So if anyone's taken Math 51, or not Math 51, Econ 50, this is your budget constraint. If you don't get a reverse mortgage, you can consume and consume and consume, and my hand keeps shaking, up to your liquidity constraint. Or you can get a reverse mortgage, which relaxes the restraint, but which lowers your budget constraint, right? So Mr. A is happy up here without one. Mr. B, Mrs. B, consumes up to the liquidity constraint and is at a corner solution. And then C gets a reverse mortgage and is happy over there with relaxed liquidity constraints. You can zone out for this part if you're not an econ person. These are utility functions. These are these utility functions. But I mean, you can explain this pretty simply. Look, if you don't have a reverse mortgage, your utility comes from consuming stuff in retirement, and then bequesting, which includes your house, because you didn't get a reverse mortgage. But your budget constraint is such that consumption can only be up to your liquidity constraint, right? But with a reverse mortgage, you get utility from consuming in retirement and from bequesting, but without the home value. And then your budget constraint doesn't have this constraint, and it includes the payout of the reverse mortgage, actually that's R, instead of the home value. My data is the health and retirement study. If you hang around super long enough, you'll hear about it. I just matched the sample in the paper that I was working based on, 96 to 2006, retirees age 65 to 99. Basically, you just feed all these data points. There's about 5,000 data points when you make all the restrictions into the model. It's a rational choice model. You force them to get a reverse mortgage, and then you force them not to. You see which one gives them greater utility. Once you know which one they would do, you just mark how much they would consume and spend under each condition, and then by extension, how much they would bequest. I realize I'm talking really quickly. I'm at about 11 minutes. So results, I'll go through this. This is just the demographic info for the whole data set, and this is for the reverse mortgage taking group. The whole point here is to just underscore the comparisons. They're slightly older, they're slightly more frequently female, they're more frequently people of color, and single people. Generally, I mean, these are just all groups that are stereotypically more financially vulnerable in retirement. They would need the liquidity. And then also, as I described before, these are people who are house rich and cash poor. Their homes are worth a lot, but they don't have a lot of money. This is the real answer to the bequest question. There's a lot of stuff. Let's focus up here. This is a comparison of how much is bequested by people who would not get a reverse mortgage versus how much is bequested by people who do. They bequest 64% less. And then this is an in-group comparison. So if we just look at the people who would prefer a reverse mortgage, and then we say, okay, how much would they bequest if they couldn't get one? And then how much would they bequest if they could? It changes by about 70%. And that number is pretty constant across demographic groups. Yeah, no matter what demographic group you're in, if you are someone who wants to get a reverse mortgage and then you do, your bequest is generally reduced 70%. Now, where does that come from? It comes from differences not in budget constraint and in allocations over consumption and saving. So if you are someone who wants to get a reverse mortgage, you start out consuming really, really little, 94% less than people who would not ultimately get one. And that's just because you have no cash. You can't consume if you don't have money. Underscoring that is that when you allow these people to get a reverse mortgage, they increase consumption 466%. They have so much pent-up consumption demand, but they can't do it. Similarly, once they're able to get their reverse mortgage, we don't see them reallocating to kind of mitigate the loss. They end up allocating less towards saving. This looks at the same idea just as a proportion of budget constraint and instead of as dollars. You see people who would ultimately get a reverse mortgage but who can't get one consuming really, really little as a proportion of their budget constraint just because it's so little of their budget constraint is cash. And then once they're able to get the reverse mortgage, they reallocate a huge proportion of their budget toward consumption. Now here's an interesting comparison. If you compare the groups who would and wouldn't, the people who would get a reverse mortgage, when they're able to get one, they allocate a lot less of their budget towards saving. But the people who don't want one, if you force them to get one, they actually do mitigate the losses. They increase the proportion of their budget they allocate to saving. So that's an important distinction. The people who would get a reverse mortgage don't try to mitigate the losses. And in fact, the thing that we were hopeful for, the idea that people were going to try to mitigate the losses, only exhibited among people who would not get a reverse mortgage. I talked before about corner solutions. Basically, intuitively, intuitively, if you, to be someone who would want a reverse mortgage, you have to be someone who's already over here. You're consuming and consuming, and you want to consume more. So you agree to lower your budget constraints so you can consume over there. But, so if we look at this, we see that 100% of the people who do get a reverse mortgage would reach a corner solution without one, which makes sense. But the interesting thing is this. About a third of people who would not get one are at a corner solution, but still don't want a reverse mortgage. And why is that? We can look at a comparison of the demographics of the two different groups. Here you have people who would get a reverse mortgage. Here you have people who get up to their liquidity constraint, but then look at a reverse mortgage and say, I don't want that. And you see that the change in budget constraint that a reverse mortgage would require for those two different groups of people is totally different. People who would get a reverse mortgage had their budget constraint reduced $10,000, but people who get to a corner solution but still don't want one had their budget constraint reduced 8 times as much. And that comes from differences in their wealth profiles, right? The people who would get a reverse mortgage fit more readily into the stereotype of being very house rich, right? They have more home value, but cash poor. They have very little mean income. Yeah. So the point is to underscore here that reverse mortgages are not just like a small thing. This is a huge financial decision. It requires a really substantial reduction in your budget constraint. So distributional effects, this looks at who gets them. Who would get a reverse mortgage? Well, the people at the lowest income quintile get them the most, and then you see there an effect where as most of your net worth is from your home, so as your home becomes more valuable, it becomes you're more incentivized to get one, but then it drops off because if you're in the 5th quintile, you're probably very wealthy. Then we see bequest change. How much does your bequest change? Well, it's biggest for the poorest people and smallest in relative terms for the richest people. But there's this kind of sweet spot, right? You can imagine 3 buckets of people. You have the poor, who are likely to get a reverse mortgage, but who aren't really going to bequest much to their kids because they're poor. And you have rich people who do give big bequests. They give most of the bequests, but they're unlikely to get a reverse mortgage. But then you have this sweet spot with regard to the macroeconomic impacts that we talked about, right in the middle. So imagine someone who is rich enough, middle class, they might give a non-negligible bequest to their kids, but they're also kind of likely to get a reverse mortgage. So when we talk about the intergenerational effects of this, these are really who we're talking about, right? Middle class people whose kids could be middle class, but who could lose the bequest and then end up not middle class. We talked before about Social Security insolvency. I reran everything that we did before, but with Social Security payouts reduced to 75% of the promised value, or 79%, which is what the administration said they would be reduced to, and in the event of insolvency. I'm going to just go through this really fast to save you it. Basically, if the Social Security trust funds become insolvent, the model predicts that origination will go up 27%, and that you'll notice a shifting among the most vulnerable groups from dispreference to preference, just because they will really need the cash. Bequests go down for everybody, and the amount that bequests are reduced when you add reverse mortgages goes up. And that's because the bequests among the people who wouldn't get one stay pretty similar, but the bequests among people who would get one go down a lot. Too long, bottom line is everyone ends up worse off in the event of Social Security insolvency. And this is really just the tip of the iceberg of issues. I mean, we could be talking about poverty rates. Like, something needs to be done. So, discussion, cutting to the chase. Yeah, there's a huge decrease in bequests across groups with reverse mortgages added. The people who get reverse mortgages are extremely liquidity constrained. They consume extremely little in the absence of the ability to get one. The corner solution thing underscores that this is not a small financial decision. This is not something that people do to get small liquidity boosts. The distributional effects imply a sweet spot for the macroeconomic impacts we talked about before. We can imagine someone who's in the middle class who might give a non-negligible bequest, becoming slightly more likely to get a reverse mortgage, and in doing so, making it slightly more probable that they, a middle-class boomer, will have kids who will end up being middle to lower middle-class millennials. Social Security reductions compound the problem across the board. Various limitations. The HECM program was reformed in 2013 a little bit. I mean, the railings are all the same, just changed like the payout cap, different proportion of home value that you can get. I didn't talk at all about transfers from kids to their parents. If your parents are poor, you may end up just giving them cash. But I mean, that's a whole different area of research. Maybe that makes you poor too. I didn't talk at all about estate taxes. They're not factored into the model. Federal estate taxes are only paid by very, very few people. They don't come into play unless your estate is more than $5 million, which would have affected 0.7% of the people in my model. There are more state-level estate taxes, but the data I used didn't have state-level identifiers in the public data set. So if there's a junior here who wants to go get the private data set and do this thesis again, more power to you. Of course, the real big area of further study is that someone should take these changes in bequests that I noted and plug them into a life cycle model of wealth generation, right, to kind of evidence this point. But there was the gap that you couldn't just go straight to the model, you had to show how much bequests changed, which is what I was doing. So to the policy side, here's the easy point. We need to do something about Social Security. It's going to be insolvent. We're on that path. But here's the tougher point. An interesting question to ask is what a reverse mortgage does. And in a simple sense, it helps marginally more likely to move people who were slightly more likely to just agree to downsize and move. And it says to those people, no, actually, you can stay in your home. But it's at a potential macroeconomic cost, which raises the question of what the government could be doing instead, right? And of course, what they could be doing instead is helping people get liquidity through liquidation, right? Helping people who are marginally less likely to move do exactly that. And sure, that's a big policy question. That's any number of theses that you can write in the future. How can the government incentivize this for people? But I mean, that's one problem versus many problems that will likely come from this like huge loss of wealth transfer. And if there is this macroeconomic impact, are we prioritizing the comfort of baby boomers who are getting reverse mortgages precisely because they just don't want to move over the financial solvency of future generations? We might be. An important point is also that I'm not saying that anybody should be mandated to bequest. Marcelo tells me that in Argentina, people actually legally have to bequest to their kids. I'm just saying that, I'm not saying we should ban a bad behavior, I'm saying we should stop encouraging it. And then more broadly, we have weird ideas about retirement in America. We've gotten very good at helping people live very long and have a nice quality of life, and we've decided we're not going to save for it. And so that means we either have to change our expectations about retirement or change our expectations about the workforce. Because reverse mortgages aren't going to solve the problem. So, thank you. Yes?
What is the increased consumption being spent on? Is it healthcare? Is it college for your kids? Is it a trip?
Right. So, given how poor these people are, I'd assume it's just basic things. Medical spending is modeled as part of the budget constraint.
Okay.
So, but we can imagine a reallocation from like Medicare,
Yeah.
right, to private insurance. Those people would still get Medicare, but yeah, it could include anything. I imagine though that yeah, these people aren't being lavish.
Yeah.
They are very liquidity constrained.
Can you explain a little more what it means to include healthcare in the budget constraint?
So medical spending was subtracted in the same way that you might subtract, yeah.
Thank
you. The assumption there was that you don't have a choice.
Yeah.
Right.
Right.
Yes.
Does any of your analysis look at how this impacts affordable housing in an area like California where property
No, I didn't look at that at all.
I wonder if keeping these people in their homes is contributing to scarcity in the housing market.
Yeah, that's a great thesis. Though one could argue that if we start encouraging seniors to sell their homes, you can deflate housing prices, which can have other impacts.
But all of you
Such
get
as econ.
nationwide.
Yeah, this is nationwide.
This is a fairly small number of people who do reverse mortgages, right?
It's small but growing is the point, right? Yeah.
So what would the, if you were to, if people didn't have, or knew less about this option or were scared about it, what would they do instead? What's the alternative?
Well, I would tell them to sell their home, as opposed to staying in it.
Okay. And would they then spend that money?
They would spend it on, right, so they would spend it on rent, but they would probably be less liquidity constrained. No? Yeah, I mean, they would spend the money, it's presumed.
But isn't the typical economist answer to retirement savings buy an annuity when you hit 65, when you retire? And isn't this sort of like buying an annuity? So you have insurance against?
I would say it's a very inefficient annuity, maybe.
Is it because it's not fairly priced?
It's hard to get a sense of whether they're fairly priced. It's a weird market. You get about 60% of the value of your home. There are huge origination fees. They're becoming less predatory. But, I mean, one can imagine downsizing and just buying an annuity, buying a condo, or renting a condo, and also buying an annuity. And I imagine that would be more efficient. Also, there's the whole bequest consideration, right?
But that would, if buying an annuity gets rid of the bequest too.
I don't know if I can answer that question. Yeah.
Is there regional variation in where most reverse mortgages originate?
Yes, it has to do with a lot of with regional changes in their wealth profiles. It's actually in the written piece.
Yeah, I'm sure.
The HRS data identifies census divisions, so there's 9 census divisions,
Yeah.
and there's huge variation.
What has the most and what has the least?
I think actually the Pacific region. Californians typically have a lot of debt, if I'm not wrong, which would evidence that they're probably more liquidity constrained.
Yeah.
But yeah. So that was a hand. Oh.
Gosh.
Yeah.
Your results showed that there was a racial disparity between people of the same income level in likelihood in taking on the RM. So, do you have any ideas of why that would be?
So that actually wasn't controlling for income. Yeah.
Okay.
It was literally just like, what is the variable for reverse mortgage take-up rate for this ethnic group?
Okay.
Yeah. Yes.
Do you think the race matters because people of color are initially less likely
So they
to
all-
have requests?
They're substantially less likely to have access to defined contribution plans, is one reason. Yeah.
Interesting. And that's because of employment, what jobs they have, is that how it works?
Yeah, I mean, it's probably a reflection of broader things, right? They tend to have lower incomes, they're less likely to be homeowners, right?
You share the results of your research with your parents.
My mom asked if this is being recorded. Hi. She actually emails me now because she gets the reason I found out about these, right, is that I was working at CFPB, and this company AAG, which is like a really big reverse mortgage originator, rolled out this new ad campaign with Tom Selleck in it, and a bunch of people were watching it around a computer and they thought it was hilarious. But then this guy John Ogilvy was like, no, this is actually very worrying because these things are growing, and my mom gets emails about them now and forwards them to me. It's like, well, yeah. So I wonder. I was going to ask if there were a greater quantity of senior people here, if they had gotten an advertisement for one recently. I imagine very few of you have.
So is the market not competitive for these reverse mortgages?
I mean, it's becoming more competitive. It's very intervened in federally.
Yeah.
CFPB did a report recently on them being predatory, but I mean, the bigger issue is just that, well, in my mind, is the effect on Bequest that they might have.
Great.
All right.
Thank you.